The moment the news of escalating conflict began circulating across global media, something unusual started happening in financial markets. Oil prices suddenly surged with incredible speed, catching the attention of traders around the world. Within minutes, screens across trading desks lit up with aggressive buying activity. Energy markets rarely move this violently without a reason, and experienced investors immediately understood that this was not a routine fluctuation. Something deeper was unfolding. When oil moves like this, it acts as a warning signal for the entire global economy. Energy sits at the center of almost every economic activity. Transportation. Systems rely on it. Manufacturing depends on it. Global supply chains are powered by it. So when oil spikes sharply, investors begin asking a critical question. What exactly is about to change in the economic landscape? But the most fascinating part of the story did not stop with oil. Almost immediately after crude prices surged, another reaction began spreading across markets. Gold started climbing rapidly, attracting a wave of safe haven buying. Then something even more interesting happened. Silver began rising even faster than gold. This combination instantly grabbed the attention of market veterans because historically, when oil, gold, and silver begin moving together during geopolitical stress, it often signals that global capital is repositioning for uncertainty. Think about the psychology of investors during moments like this. Large institutions manage billions of dollars, and they cannot afford to ignore risk signals. When conflict escalates and energy markets react violently, those institutions start moving money into assets that have historically protected wealth. Gold has played that role for centuries. It is viewed as a financial anchor during instability because it does not rely on any single government, currency, or financial system. Silver, however, adds another dimension to the story. While gold is primarily seen as a store of value, silver carries a powerful industrial identity. It is used in electronics, solar technology, electric vehicles, medical equipment, and advanced infrastructure. That means silver sits at the crossroads between financial markets and the real economy. When uncertainty rises and investors rush into metals, silver benefits from both investment demand and industrial demand. Now imagine the forces currently colliding in global markets. On one side, geopolitical tensions are pushing oil prices higher, creating fears about energy supply disruptions and rising inflation. On the other side, technological expansion continues increasing the demand for metals like silver that power modern infrastructure. When these two forces meet, the result can be powerful price movements that surprise even experienced traders. This is exactly why moments like this attract so much attention in commodity markets. Oil spikes rarely exist in isolation. They often trigger ripple effects that travel through currencies, equities, and precious metals. Traders begin examining every detail of the situation, trying to determine whether the move represents a temporary shock or the early stage of a much larger trend. History offers several examples where energy shocks became the spark that ignited major commodity rallies. During past geopolitical crises, oil was often the first market to react. Then gold followed as investors sought financial safety. Eventually, silver accelerated as both industrial demand and investment demand combined to push prices higher. When this chain reaction unfolds, commodity markets can enter powerful cycles that last far longer than most people initially expect. Right now, traders across major financial centers are watching closely to see if a similar pattern might be forming again. The initial signals are already appearing. Oil surges as conflict risk rises. Gold attracts defensive capital. Silver gains momentum even faster. These are not random movements. They are signals that capital may be shifting across the global financial system. But before jumping to conclusions, it is important to understand something crucial. Not every geopolitical shock creates a long-term commodity rally. Sometimes markets react strongly in the beginning but calm down once tensions ease. Other times, however, the situation continues evolving, and the initial reaction becomes the starting point of a much larger trend. That is the question investors are trying to answer right now. Is this simply a short-term reaction to breaking news, or is the market beginning to price in deeper structural risks that could keep commodities elevated for a long time? The answer to that question will determine whether the rally in gold and silver continues gaining strength or fades once headlines settle. And to understand where this situation might lead next, we need to look much deeper into what actually caused oil to explode upward in the first place. Because the real trigger behind that spike may reveal whether the current market reaction is temporary panic, or the early stage of a much bigger commodity shift that investors have not fully recognized yet. Have you noticed your wallet feeling a little lighter lately? From the gas pump to the grocery store, it seems like everything is getting more expensive, and a big reason for this is something we often take for granted: the price of oil. In recent weeks, we've seen oil prices surge dramatically, and today we're going to break down what this really means for the global economy and for your investments, especially precious metals like gold and silver. So why are oil prices skyrocketing? It's a classic case of supply and demand, but with a few modern twists. On the supply side, major oil-producing nations have been cutting back on production to keep prices stable. Add in geopolitical tensions in key oil regions, and you have a recipe for a supply squeeze. On the demand side, as economies around the world bounce back from the pandemic, the thirst for energy is stronger than ever. More planes in the sky, more cars on the road, and more factories running at full tilt all mean one thing: a massive demand for oil. When tight supply meets roaring demand, prices have nowhere to go but up. This isn't just about what you pay at the pump. Oil is the lifeblood of the global economy. Think about it, almost everything you buy has to be transported, and that transportation runs on fuel. When fuel costs go up, so does the cost of shipping. That means the price of your food, your clothes, your electronics, everything gets a little bit higher. This is called inflation, and it's like a hidden tax on your savings. Your money just doesn't go as far as it used to. For businesses, higher oil prices mean higher operating costs. Airlines have to pay more for jet fuel, trucking companies face bigger bills, and manufacturers see their energy expenses climb. To stay profitable, they often have to pass these extra costs on to us, the consumers. This can lead to a slowdown in consumer spending because when everyday necessities cost more, we have less money left over for other things, like going out to eat or buying a new gadget. If this trend continues, it can put the brakes on economic growth and, in a worst-case scenario, even tip economies into a recession. Now let's talk about how this all connects to gold and silver. When people get nervous about inflation and economic uncertainty, they often look for safe places to put their money. These are called safe haven assets. For centuries, gold and silver have been the ultimate safe havens. Unlike paper money, which can lose its value due to inflation, precious metals tend to hold their value or even increase in value during times of economic turmoil. Think of it this way: when the value of the dollar is falling because of inflation, it takes more dollars to buy the same amount of gold. So the price of gold in dollars goes up. This makes gold a fantastic hedge against inflation. When you see oil prices surging and hear talk of rising inflation, you'll often see the price of gold climb right alongside it. Investors are essentially trading their paper currency for the timeless security of physical gold. It's not just big-time investors and central banks who are doing this. Everyday people are also turning to gold and silver to protect their wealth. Buying gold or silver coins and bars has become a popular way for individuals to safeguard their savings from the eroding effects of inflation. It's a tangible asset you can hold in your hand, offering a sense of security that digital or paper assets just can't match. Silver plays a similar role to gold as a monetary metal and a safe haven asset. However, silver has a dual personality. It's not just a precious metal. It's also a critical industrial metal. Silver is used in everything from solar panels and electric vehicles to smartphones and medical equipment. As the world pushes towards a greener, more technologically advanced future, the demand for silver in these industries is set to explode. This creates a fascinating dynamic. When the economy is strong, industrial demand for silver is high, which can push its price up. But when the economy is weak and investors are looking for a safe haven, they also flock to silver, which also pushes its price up. This dual demand, both industrial and investment, gives silver a unique and powerful potential for growth. With rising oil prices signaling economic uncertainty, the investment demand for silver is getting a major boost. So what does this all mean for you? The surge in oil prices is more than just a headline. It's a signal. It's a sign that inflation is here and that economic uncertainty could be on the horizon. While this can be unsettling, it also presents an opportunity. It highlights the importance of diversifying your investments and protecting your purchasing power. This is where gold and silver truly shine. They offer a proven way to shield your wealth from the very economic forces that rising oil prices can unleash. As we watch the ripple effects of expensive oil spread through the global economy, the appeal of these timeless precious metals becomes clearer than ever. They aren't just shiny rocks. They are pillars of financial stability in an unstable world. Understanding these connections is the first step toward making smarter financial decisions. By paying attention to signals like the price of oil, you can better navigate the economic landscape and take steps to secure your financial future. Whether you're a seasoned investor or just starting to think about your savings, the story of oil, inflation, and precious metals is one that affects us all. Thank you so much for watching. I hope this breakdown was helpful in connecting the dots between the gas pump and your portfolio. If you found this video insightful, please give it a thumbs up and consider subscribing for more content on finance and the economy. We'd love to hear your thoughts in the comments below. Until next time. Stay informed and invest wisely. When most people hear about silver rising during a market crisis, they assume it is simply following gold. But the deeper reality of the silver market is far more powerful than that. Silver is not just a precious metal sitting quietly in vaults. It is one of the most important industrial metals driving modern technology, and that role changes everything about how its price behaves during periods of global tension. To understand why silver can move so dramatically, we need to look at where the metal is actually used in the real world. Unlike gold, which is primarily held as a store of value or used in jewelry, silver is consumed by industries at a massive scale. Once silver enters many technological systems, it is extremely difficult or expensive to recycle. That means a large portion of the silver mined each year eventually disappears into the global industrial machine. One of the fastest growing sources of demand comes from the renewable energy revolution. Solar panels rely heavily on silver because of its unmatched ability to conduct electricity efficiently. Every solar panel installed across rooftops, solar farms, and infrastructure projects requires a small amount of silver inside its circuitry. Individually, the quantity may appear small, but when millions of panels are being produced around the world, the total demand becomes enormous. Governments across the globe are investing billions of dollars into expanding renewable energy capacity. The United States has been pushing aggressive policies to accelerate solar adoption as part of its energy transition strategy. Massive solar installations are being constructed across multiple states, and each new project adds additional demand pressure on the silver market. This means that while investors are buying silver during financial uncertainty, the clean energy sector is quietly consuming large quantities of the metal at the same time. But solar energy is only one piece of the puzzle. Silver is also deeply embedded in the electronics industry. Every smartphone, computer, medical device, and advanced circuit board uses silver because of its superior electrical properties. As technology becomes more advanced and more devices are produced every year, the demand for high-performance conductive materials continues expanding. Silver sits right at the center of that technological ecosystem. The electric vehicle revolution adds another layer of demand that investors are beginning to notice. Modern electric vehicles require advanced electrical systems and battery infrastructure that rely on highly conductive materials. Silver plays a role in these systems, particularly within complex electronic components and charging infrastructure. As governments and companies push toward electrification of transportation, the industrial demand for silver increases even further. Now imagine what happens when geopolitical tensions push investors toward precious metals at the same time industrial demand is already rising. That is the unique dynamic of the silver market. During financial stress, investors rush towards safe haven assets like gold and silver. But while gold demand mainly comes from financial buyers, silver demand comes from both investors and industrial consumers simultaneously. This dual demand structure can create explosive price movements once momentum begins building. There is also an important psychological factor that influences silver's behavior in markets. Silver is a much smaller market compared to gold. The total value of all silver available for investment is far lower than the global gold market. Because of this smaller market size, it does not take nearly as much capital to move prices. Significantly, when large institutional investors begin allocating funds towards silver, the impact on price can be much more dramatic than in larger markets. This is why silver often outperforms gold during strong commodity rallies. Gold may rise steadily as investors seek stability, but silver tends to accelerate once momentum builds. Traders sometimes describe this as silver having a turbo effect compared to gold. When capital flows into the precious metals sector, silver can move faster, and further because of its smaller market and stronger industrial demand. Right now, the global environment is creating the perfect conditions for that kind of dynamic. On one side, geopolitical tensions and energy market instability are pushing investors toward defensive assets. On the other side, technological expansion and clean energy development are increasing the long-term industrial demand for silver. When these two forces meet, the result can be a powerful upward pressure on prices. However, demand is only half of the equation in any commodity market. Even if demand grows rapidly, prices cannot rise dramatically unless supply struggles to keep up. This brings us to another critical aspect of the silver story that many investors overlook. The global supply of silver is far more constrained than most people realize, and expanding production is not nearly as simple as opening a new mine. Many silver deposits around the world are actually mined as a byproduct of other metals like copper, lead, or zinc. This means that silver production often depends on the economics of entirely different mining industries. If those industries slow down or reduce production, silver output can also decline even if silver demand remains strong. This structural limitation can create supply bottlenecks during periods when demand accelerates rapidly. Another Challenge is the long timeline required to develop new mining projects. Discovering a new deposit, securing permits, financing construction, and building a functioning mine can take many years. Commodity markets, however, can shift far more quickly than that. When demand suddenly rises, the supply side of the market often struggles to respond fast enough. That imbalance between supply and demand can push prices much higher than expected. Now consider the current situation unfolding in global markets. Oil prices have surged due to geopolitical escalation, raising fears about inflation and economic instability. Investors are moving capital toward precious metals for protection. At the same time, industries tied to technology and renewable energy continue consuming silver at increasing rates. All of this demand is entering a market where supply expansion is slow and complex. For traders and analysts watching these developments, the question becomes increasingly interesting. If geopolitical tensions remain elevated and industrial demand continues expanding, could the silver market experience a major supply-demand imbalance? And if that imbalance begins forming, how high could prices potentially move before the market finds equilibrium again? These are exactly the questions institutional investors are starting to examine right now. Because when commodities enter a cycle where demand grows faster than supply can respond, the resulting price movements can sometimes surprise even the most experienced market participants. But there is still another piece of the puzzle that could dramatically influence how this story unfolds, because large institutional investors and central banks often play a decisive role in shaping major commodity trends. And the signals coming from those powerful players could reveal whether the current rally in gold and silver is just beginning, or already preparing for something much larger. When markets begin reacting to global tension the way they are now, experienced investors know that the real story is not always visible on the surface. Price charts show movement, headlines show breaking news, but behind those visible signals there is another layer of activity taking place. Large institutions, hedge funds, commodity trading houses, and even central banks begin adjusting their strategies long before the public fully understands what is happening. And when those powerful players start repositioning capital, their decisions can shape the direction of entire markets. Think about the scale of money these institutions control. A major hedge fund can manage tens of billions of dollars. Large pension funds and sovereign wealth funds manage hundreds of billions. Central banks operate with even greater financial influence. When entities of that size decide to increase exposure to commodities like gold or silver, the ripple effect spreads across global markets very quickly. Even a small percentage shift in allocation can translate into massive demand. This is why professional traders always watch institutional behavior closely. Retail investors often react to news after it becomes obvious, but institutions usually move earlier, guided by risk models, economic data, and geopolitical intelligence. When energy prices spike because of escalating conflict, institutions do not simply watch the headlines. They begin analyzing how that event could reshape inflation expectations, currency stability, and global economic growth. Based on those assessments, they quietly start repositioning their portfolios. Gold is typically the first precious metal that attracts large institutional flows during uncertain periods. Central banks in particular hold gold as part of their foreign reserve strategy. Over the past several years, many central banks have been steadily increasing their gold reserves, reducing reliance on traditional currency holdings. This trend alone has created strong structural demand in the gold market. When geopolitical tension appears, that existing demand can accelerate even further. Silver, however, often becomes the second stage of the institutional strategy. Because silver is more volatile and tied to industrial demand, large funds sometimes approach it cautiously at first. But once a commodity rally gains momentum and confidence builds that precious metals may continue rising, institutions often expand their exposure beyond gold. At that moment, silver begins attracting larger flows of capital. And because the silver market is significantly smaller than gold, those capital flows can produce powerful price acceleration. Commodity trading houses also play a critical role in these moments. These firms operate directly within the physical commodity supply chain. They track shipping routes, production levels, refinery activity, and industrial demand across multiple countries. When geopolitical escalation threatens energy supplies or trade routes, these companies quickly evaluate the potential impact on commodity availability. If they believe shortages could emerge, they may increase their hedging activity or accumulate physical inventories. That behavior can further tighten the market and push prices upward. Another layer of institutional activity occurs within futures markets. Futures contracts allow large traders to gain exposure to commodities without immediately buying physical supply. Hedge funds often use these instruments to position themselves for potential price movements. When multiple funds begin taking bullish positions in gold or silver futures at the same time, momentum can build rapidly. Other traders notice the growing positions and start following the trend, creating a self-reinforcing cycle of buying pressure. Right now, analysts are closely monitoring these institutional signals. Open interest levels in commodity futures markets are being studied carefully. Analysts are examining whether large traders are increasing long positions in precious metals. They are also watching capital flows into commodity-focused exchange-traded funds that track gold and silver prices. When these indicators begin rising together, it often suggests that professional money managers are preparing for a broader commodity move. Currency markets add another important dimension to this picture. When geopolitical risk increases, investors often become cautious about holding large amounts of cash in certain currencies. If energy prices remain elevated, inflation concerns can weaken confidence in monetary stability. Precious metals sometimes benefit from this situation because they are not tied to the policy decisions of any single government. Gold and silver function as globally recognized stores of value, making them attractive alternatives during periods of currency uncertainty. At the same time, institutional investors are constantly evaluating the long-term economic landscape. They are asking questions that go beyond today's news headlines. Will energy markets remain volatile for months or even years? Will inflation pressures return if oil continues climbing? Could supply chain disruptions reappear if geopolitical tensions expand further? The answers to these questions influence how aggressively institutions allocate capital toward commodities and precious metals. Another factor that cannot be ignored is investor psychology. Markets are driven not only by economic fundamentals but also by collective perception. When enough large investors begin believing that commodities are entering a new bullish phase, their buying behavior can reinforce that narrative. As prices rise, more investors become convinced that the trend will continue. This attracts additional capital, creating a cycle where rising prices generate more demand, which then pushes prices even higher. Silver is particularly sensitive to this type of momentum-driven environment. Because the market is relatively small and liquidity is lower compared to larger asset classes, price swings can become dramatic. Once enthusiasm spreads among investors, during previous commodity cycles, silver has produced some of the most explosive rallies in the metals sector. Traders who understand this dynamic watch silver closely for early signs that institutional capital is beginning to accelerate the trend. All of these elements are now interacting at the same time. Energy markets are reacting to geopolitical escalation. Gold is attracting safe haven demand. Silver is benefiting from both investment, interest, and strong industrial fundamentals. Meanwhile, large institutions are quietly evaluating how these forces could reshape the commodity landscape in the months ahead. The combination creates an environment filled with both opportunity and uncertainty. But before drawing final conclusions about where this market could go next, it is important to step back and examine the full picture, because the future of gold and silver will ultimately depend on how several key forces evolve from here. The trajectory of geopolitical conflict, the stability of energy supplies, the persistence of inflation, and the behavior of institutional capital will all play decisive roles. Understanding those factors together allows investors to see beyond short-term headlines and focus on the broader trends shaping global markets. And once we connect all these pieces of the puzzle, the story of this oil spike and the precious metals rally becomes much clearer. As we step back and connect every piece of this unfolding story, a much clearer picture begins to emerge. What initially appeared to be a sudden spike in oil prices was not just a random movement in a single market. It was the first signal in a chain reaction spreading across the global financial system. Energy markets reacted immediately to escalating geopolitical tension. Investors saw the risk and began adjusting their expectations about inflation, supply chains, and economic stability. That reaction quickly spilled over into precious metals, pushing gold and silver higher as capital searched for protection and opportunity. Throughout this discussion, we have explored how each element of the market fits into this larger narrative. Oil surged because conflict raises fears about energy supply disruptions. When energy becomes unstable, inflation risks grow, and investors begin looking for assets that can protect wealth during uncertain times. Gold naturally becomes the first destination for that defensive capital because of its long history as a global store of value. But silver adds an entirely different dimension to the story. Unlike gold, which is primarily held as a financial asset, silver exists at the intersection of finance and industry. It is deeply embedded in the technologies shaping the modern world. Electronics, medical equipment, advanced infrastructure, and renewable energy systems all rely on silver's unique properties. This means that whenever investors begin buying silver for financial protection, they are entering a market that already has strong industrial demand pushing from another direction. That dual demand structure is one of the most powerful forces in the commodities world. When financial demand and industrial consumption begin rising together, the pressure on prices can build quickly. And because the silver market is much smaller than gold, it takes far less capital to create dramatic price movements. History has shown that once momentum enters the silver market, rallies can accelerate far beyond what many investors initially expect. We also explored another critical part of the equation, which is supply, silver. Production cannot expand rapidly in response to rising demand. Many silver deposits are mined as a byproduct of other metals, meaning supply depends partly on the economics of completely different industries. Developing new mines takes years of exploration, financing, and construction. When demand increases faster than supply can respond, the market begins tightening, and that tightening can amplify price movements even further. At the same time, institutional investors and central banks are constantly evaluating these dynamics behind the scenes. Large funds watch energy markets, inflation data, currency stability, and geopolitical developments to determine where capital should flow next when they begin shifting even a small percentage of their portfolios. Toward commodities, the effect on prices can be significant. Futures markets, commodity funds, and physical inventories all start reflecting that institutional positioning. So what does all of this mean for the situation unfolding right now? It means that the spike in oil prices may be more than just a temporary reaction to breaking news. It could represent the first stage of a broader market adjustment where investors begin preparing for a world of higher geopolitical risk, tighter energy markets, and persistent inflation concerns. If those conditions continue developing, precious metals like gold and silver could remain at the center of investor attention. However, markets are complex and constantly evolving systems. Not every geopolitical shock leads to a long-term commodity rally. If tensions ease quickly and energy supplies stabilize, oil prices could retreat and some of the pressure on metals may fade. But if the conflict continues intensifying, if energy disruptions become more serious, or if inflation fears return strongly, then commodities could experience a much larger and longer-lasting movement. This is why experienced investors focus on signals rather than predictions. They watch the behavior of oil markets to see whether energy prices remain elevated. They monitor gold for continued safe haven demand, and they pay especially close attention to silver, because when silver begins accelerating faster than gold, it often signals that momentum is spreading throughout the entire metals sector. Right now, those signals are beginning to appear, and that is exactly why global traders are watching this moment so closely. The combination of geopolitical escalation, energy volatility, industrial demand, and institutional positioning creates a powerful mix that has historically produced some of the most dramatic commodity cycles. Whether this situation evolves into a full-scale rally or gradually fades will depend on how these forces continue developing in the weeks and months ahead. The most important lesson for investors is to stay informed and think beyond short-term headlines. Markets rarely move based on a single event, they move because multiple forces gradually align in the same direction. When energy markets, inflation expectations, institutional capital, and industrial demand begin pointing toward the same outcome, the results can reshape entire sectors of the global economy. Moments like this remind us that understanding market signals is far more valuable than reacting to panic or excitement. Investors who study the relationships between energy, commodities, and global risk are often able to recognize opportunities long before they become obvious to everyone else, and that is exactly what we focus on here. If you want to continue understanding the signals shaping global markets, make sure you subscribe to Signalscope Markets. On this channel, we break down major developments in commodities, precious metals, and financial trends so you can see the bigger picture behind every market move. Stay connected with Signalscope Markets, because the next major shift in gold, silver, and global commodities may already be beginning to unfold.